There's a number that changed everything, and most people missed it entirely. $682.6 billion. That's what remains of China's stake in American debt as of January 2026. To understand why this matters, you need to know what that number used to be. In 2013, China held over $1.3 trillion in US Treasury bonds. They've liquidated $600 billion worth of American government debt in just over a decade, and the exit is accelerating. This isn't portfolio rebalancing. This is the dismantling of the financial architecture that has underwritten American power for half a century. While your newsfeed fills with stock market noise and political theater, the world's second largest economy is quietly severing the mechanism that kept US borrowing costs artificially suppressed for generations. The technical term is the dollar recycling system. The simple version is this: China sells us goods, we pay them dollars, they loan those dollars back to our government by buying treasury bonds. That loop is breaking. The last time China's holdings were this low, Lehman Brothers had just collapsed and the global financial system was in freefall. But in 2008, China was racing to buy more American debt to stabilize the crisis. Today, they're doing the opposite. They're selling into a market where the US government needs to borrow trillions, not billions, just to keep the lights on. This is what a structural shift looks like before it becomes a crisis. And here's what connects your mortgage rate to a central bank vault in Beijing. When the largest foreign buyer of US debt stops buying and starts dumping the interest rate on those bonds, has to rise to attract replacement buyers. Those higher rates ripple through the entire credit system. Your car loan, your credit card, your home refinance, all of it gets more expensive because China decided American debt is no longer worth holding. The official narrative calls this reserve diversification a technical adjustment in how nations manage their wealth. The reality is more direct. After watching the US freeze Russia's central bank reserves in 2022, every major power realized that US Treasury bonds aren't risk-free assets anymore. They're permission-based assets. One executive order, and $682 billion can become inaccessible. China looked at that equation and decided even their current holdings represent too much exposure. But the question nobody in mainstream finance wants to ask out loud is simple. If China is dumping American debt, what are they buying instead? The answer reveals the bet they're making about the future. For 15 consecutive months, the People's Bank of China has been accumulating gold. Over 74 million ounces now sit in their reserves. This is a pivot from digital promises to physical reality, from assets that can be frozen with a signature to assets that exist in vaults beyond the reach of Washington's sanctions apparatus. The thesis of this investigation is straightforward. We are watching the controlled demolition of the dollar's monopoly on global finance, executed by the one nation with enough leverage to make it happen. And the American middle class is about to pay the bill for 4 decades of deficit spending that was only possible because China was willing to finance it. That era is ending. The $682 billion that remains is not a safety net. It's a tactical reserve that Beijing is liquidating on their timeline, not ours. To understand how we arrived at this inflection point, we need to go back to the beginning. Back to when this system was built and why China's participation was never a favor, it was a vulnerability. And now they're exploiting it. The foundation of American economic hegemony after 1971 rested on a simple bargain. When Nixon severed the dollar's link to gold, the US needed a new way to make the world accept paper currency backed by nothing but trust. The solution was the petrodollar system. Oil trades in dollars, nations need dollars to buy energy, therefore nations buy US Treasury bonds to hold those dollars. For decades, this worked flawlessly. China's entry into this system was different. After joining the World Trade Organization in 2001, Chinese factories became the world's manufacturing floor. They exported goods to America and accumulated massive dollar surpluses. Standard economics would predict their currency should strengthen, making exports more expensive and naturally balancing trade. But Beijing had other plans. They kept the yuan artificially weak by using those dollar surpluses to buy US government debt. This kept Chinese goods cheap, American consumers happy, and US interest rates low. Everyone won, or so it appeared. By the late 2000s, China had become America's banker. They held over $1 trillion in treasury bonds, making them the single largest foreign creditor to the United States government. This created a bizarre codependency. America needed China to keep buying debt to fund deficits. China needed America to keep buying goods to fuel employment. The relationship had a name among economists: Chimerica. 2 economies, 1 system. The mechanism was elegant in its simplicity. Every month, the US Treasury would auction new bonds to fund the deficit. Chinese state entities would show up as reliable bidders, absorbing hundreds of billions in debt. This demand kept yields low, which kept borrowing cheap, which allowed Congress to spend without immediate consequences. The national debt grew from $5 trillion in 2000 to over $38 trillion today. That growth was only possible because foreign central banks, led by China, were willing to finance it. But the system contained a hidden timer. China was accumulating claims on future American productivity in the form of treasury bonds. The assumption was that the dollar would remain stable and that those bonds would always be liquid and valuable. That assumption is now being tested. When Russia's $300 billion in reserves were frozen in 2022, Beijing's strategists recognized a fatal flaw in their position. The assets they thought were safe could be weaponized against them. The data shows the shift clearly. In 2013, China peaked at $1,316 trillion in US Treasury holdings. By 2020, that had fallen to around $1 trillion. As of January 2026, it sits at $682.6 billion. This isn't gradual diversification. It's a methodical exit. And the pace is accelerating precisely when the US government's borrowing needs are exploding. In 2026 alone, the Treasury Department projects it will need to borrow an additional $2.5 trillion to cover the deficit and refinance maturing debt. China used to absorb a significant portion of that issuance. Now they're adding to the supply by selling. If you're beginning to see how the pieces connect, how a decision in Beijing translates directly into higher costs in your daily life, then you're ready for what comes next. Because the mechanics I just described are only half the story. The other half is what's happening in the shadows, through offshore accounts and proxy buyers that mask the true scale of the exit. And that's where this gets genuinely concerning. Here's what the official data doesn't capture. In late 2025, analysts noticed something unusual in the Treasury International Capital reports. Belgium and Luxembourg, two small European nations with limited domestic capital, suddenly showed massive increases in their US Treasury holdings. Belgium's economy is smaller than Ohio's. Luxembourg has fewer people than San Antonio. Yet, according to the data, they were buying tens of billions in American government debt. The consensus among institutional analysts is clear. These aren't Belgian investors. These are custodial accounts, third-party vehicles that allow China to sell US debt without the sale appearing directly in their national accounts. It's financial camouflage. By routing sales through offshore centers, Beijing can liquidate their position without triggering the market panic that would result if the world saw 100 billion dumped in a single month. The strategy is deliberate. Sell enough to reduce exposure, but not so much that the bond market collapses before you've converted those dollars into something else. What's that something else? The answer is physical. China is locking up long-term commodity supply contracts across the developing world. Copper mines in Zambia, lithium deposits in Chile, cobalt in the Democratic Republic of Congo. They're trading paper assets that can be printed infinitely for hard assets that power the next industrial revolution. Electric vehicles, AI server farms, renewable energy infrastructure, all of it requires the raw materials China is now controlling. Simultaneously, they're building financial infrastructure that bypasses the dollar entirely. The M-Bridge project, a cross-border payment platform connecting central banks in China, Thailand, the UAE, and Hong Kong, processed its first live transactions in 2024. By 2026, a significant portion of China's energy imports are being settled in yuan rather than dollars. This reduces their need to hold dollar reserves, which reduces their need to own treasury bonds. It's a feedback loop where every yuan-denominated trade justifies further selling of US debt. The domestic impact is already visible but widely misunderstood. Mortgage rates in the US remain above 7%, despite the Federal Reserve signaling potential rate cuts. The reason is straightforward. The Fed sets short-term rates, but long-term rates like mortgages are determined by the bond market. And the bond market is demanding higher yields because the reliable buyer, China, is gone. In economics, this is called the term premium. The market is pricing in the risk that there won't be enough demand for future debt auctions. That risk became reality in January 2026 when a 30-year Treasury bond auction showed a tail, meaning the Treasury had to accept higher yields than expected to find buyers. In a healthy market, auctions are oversubscribed. Investors compete to buy government debt. When auctions tail, it signals that demand is weak relative to supply. It's the government equivalent of a company struggling to sell bonds because investors doubt their creditworthiness. China's exit is creating what economists call a crowding out effect. The government's need to borrow is so large, and the pool of willing lenders so constrained that private borrowers are being priced out of the market. Small businesses can't get affordable loans. Consumers face credit card rates above 20%. The American dream, historically built on accessible credit, is becoming structurally more expensive because the foreign capital that subsidized it for decades is evaporating. And there's a darker layer beneath all of this. The trade war rhetoric of 2025, the tariff escalations and political posturing, they're the surface distraction. The real war is happening in the bond market. In late 2025, when the US announced major tariff hikes on Chinese imports, China's treasury sales spiked by over $20 billion in a single month. This is financial retaliation. They're not just diversifying, They're using their remaining debt holdings as a pressure point, a way to make American borrowing more expensive in response to American trade aggression. Everything I just walked through, the shadow accounts, the commodity pivot, the alternative payment systems, it's all happening simultaneously. This isn't a series of unrelated events. It's a coordinated strategy to decouple from dollar dependency while the exit is still possible. And the American public is largely unaware because the consequences haven't fully materialized yet. But they're coming, and the acceleration is measurable in the data that updates every month. Here's the part that should terrify anyone paying attention to long-term fiscal sustainability. The U.S. national debt now exceeds $38 trillion. The annual interest payment on that debt has surpassed $1.1 trillion. That's more than the entire defense budget, more than Medicare. It's the fastest growing line item in the federal budget, and it's growing precisely because China and other foreign buyers are demanding higher yields to hold our debt. This creates a doom loop. Higher interest rates mean higher interest costs. Higher interest costs mean larger deficits. Larger deficits mean more borrowing. More borrowing without sufficient buyers means even higher rates. The system is eating itself, and the only escape hatch is the Federal Reserve's printing press. If private and foreign buyers won't absorb the debt at acceptable rates, the Fed will be forced to step in and buy it directly by creating new money. This is called debt monetization, and every time in history it's been deployed at scale, it has ended in currency debasement. We're already seeing the early warnings. The Fed's balance sheet, which had been shrinking as they tried to unwind pandemic-era money printing, has started to stabilize. Repo market operations, the emergency liquidity injections that don't make headlines, have been increasing in frequency. These are the behind-the-scenes interventions designed to prevent yield spikes that could cascade into broader financial instability. The plumbing is straining. Meanwhile, China is positioning for a monetary system that doesn't revolve around the dollar. Their gold accumulation isn't random. Gold has been the ultimate monetary asset for thousands of years. Because it can't be printed, it can't be frozen, and it doesn't rely on any government's promise. If global trade shifts toward a system where currencies are partially backed by commodities rather than pure fiat, China is building the reserves to dominate that system. The US, in contrast, has not meaningfully added to its gold reserves in decades and holds debt that's denominated in a currency it prints. The wealth transfer is silent, but massive. American savers hold dollars and dollar-denominated assets. Those assets are losing purchasing power as the Fed is forced to choose between solvency and inflation control. China is converting depreciating paper into appreciating hard assets. When the reset comes, and the dollar's role as the sole global reserve currency diminishes, the nations holding physical resources will have leverage. The nations holding debt will have claims on a depreciating currency. Here's the question that should be keeping policymakers awake. If the US can no longer rely on foreign central banks to fund the deficit, who fills the gap? Domestic banks are already saturated with Treasury holdings and facing unrealized losses from bonds purchased when rates were near zero. Pension funds are required by law to hold government debt, but they're not large enough to absorb trillions in new issuance. Retail investors won't step in at scale because the risk-adjusted returns are terrible compared to equities or even high-yield corporate debt. That leaves the Federal Reserve as the buyer of last resort. And once the Fed starts buying government debt in size to prevent auction failures, the game is over. The central bank's independence, the idea that monetary policy is separate from fiscal policy, collapses. The Fed becomes a tool to keep the government funded, and inflation becomes a policy choice rather than an economic outcome. This is fiscal dominance, the point where the needs of the Treasury override the mandate of the central bank. China understands this endgame better than most American citizens because they've studied the collapse of every reserve currency in history. The British pound, the Dutch guilder, the Spanish real, all of them followed the same path. Overextend militarily, borrow beyond your productive capacity, debase the currency to manage the debt, lose reserve status. The timeline varies, but the pattern doesn't. And China is positioning to be the creditor, not the debtor, when the current system breaks. The $682 billion they still hold isn't a vote of confidence. It's ammunition. They can deploy it strategically, selling into moments of geopolitical tension to spike yields and create economic pressure. They can hold it as leverage in negotiations over Taiwan or trade, or they can continue the slow bleed, extracting themselves completely over the next few years while converting into assets the US can't touch. Every option benefits them. None benefit us. And that asymmetry is the revelation. We are no longer the indispensable nation in the eyes of our largest creditor. We're a risk they're actively managing down. So where does this leave us? The honest answer is in transition. We're moving from a unipolar financial world where the dollar was unquestionably dominant to a multipolar one where multiple currencies, commodities, and settlement systems compete. That transition is inherently unstable. Markets hate uncertainty, and the unwinding of a 50-year system generates enormous amounts of it. For the average American, the implications are concrete and unavoidable. The era of cheap credit is over. The 3% mortgage, the low-interest car loan, the ability to finance consumption through easily accessible debt, all of that was subsidized by foreign central banks willing to accept low returns on treasury bonds. With China exiting and other nations following their lead, the cost of capital is structurally higher. This means slower economic growth, more expensive home ownership, and a gradual erosion of living standards for anyone whose income doesn't keep pace with inflation. The policy responses available are all painful. The government can raise taxes to reduce the deficit, which slows growth and creates political backlash. They can cut spending, which is politically nearly impossible given the structure of entitlement programs and defense commitments. Or they can accept higher inflation as the implicit tax that erodes the real value of the debt. History suggests they'll choose the third option because it's the path of least resistance politically, even though it punishes savers and anyone on a fixed income. China's strategy, in contrast, is clarifying. They're reducing dollar exposure, accumulating hard assets, building alternative financial infrastructure, and positioning themselves for a world where economic power is measured in productive capacity and resource control rather than financial engineering. They looked at the American model, borrowed what worked, and are now exiting before the costs come due. The $600 billion liquidation since 2013 is a historical marker. Decades from now, economists will point to this period as the moment when the dollar's unchallenged dominance began its terminal decline. Not because of a single crisis or collapse, but because the largest creditor in the system decided the risks outweighed the returns and methodically reduced their exposure. What's in your control? The same things that have always mattered during monetary transitions. Understand that currency is a claim on future productivity, and when governments overissue those claims, the value of each claim falls. Diversify across assets that can't be printed or easily confiscated. Maintain skills and relationships that have value regardless of which currency is used for settlement. And most importantly, recognize that the financial system you grew up with is not permanent. It's a human construction, and it's being reconstructed right now by forces larger than any individual policy decision. China's exit from US debt is not the end of American economic power, but it is the end of the free lunch. For half a century, the US exported dollars and imported goods, with the difference financed by foreign central banks buying our debt. That imbalance is correcting, and corrections are never smooth. The question isn't whether there will be pain. The question is whether we recognize what's happening in time to adapt. The data is unambiguous. The trend is established. And the consequences are unfolding in real time through higher interest rates, constrained credit, and a gradual shift in where global capital flows. China didn't announce this with a press conference. They executed it through treasury auctions, gold purchases, and trade settlements denominated in yuan. The revolution is quiet, technical, and utterly transformative. The empire isn't collapsing. It is adjusting to a reality where it can no longer borrow without limit from nations that have their own strategic interests. That adjustment will define the next decade of American economic policy. And it started with a number that most people ignored. $682.6 billion. The lowest level of Chinese holdings in U.S. debt since 2008. Not a bottom. A marker on the way down. The exit is still in progress, and the final destination is a world where American debt is no longer the automatic choice for global reserves. That world is closer than most realize, and China is already there.